What is up, guys? So as promised, I'm bringing this video to you guys, just pretty much answering all the questions you guys posted on the story I put up. Now, I think one thing I saw a trend with was the fact that there's a lot of people who aren't entirely sure of how to calculate the amount of pips and their risk management, for example. So, for example, whenever I've said to people I risk between 1 and 2% of my account, they struggle to understand how to do that. And it all comes down to calculating the amount of pips you're going to be risking. So, for example, if we're going to go for a profit target of 50 pips and we're going to be risking, let's just make it a 1 to 2 risk to reward, we're going to be risking 25 pips, right? Now what needs to happen is we just go according to our lot size calculator here. As I say, you can literally just put this into your calculator and it's very easy to work out. So at the end of the day, all you need to do, if you're going to be using a 0.01 lot size and you go over here 25 pips, so you literally just go into your calculator and go 0.1 times by 25, that equals 2.5. So basically what's happening here is you're going to be risking $2.5 or $2.50 to make $5. Literally as simple as that. So as I say, put it into your calculator, use this as your guide. Obviously this goes onwards, but yeah, this is the guide you should use. Otherwise there's nothing else really to that. Basically what this guide is showing though, you should be having at least $250 in your trading account. Now this doesn't really seem like a great trade. No one really wants to make $5 per trade or even risk $2.50. It just seems meaningless. But what we're going to get into now, you're going to see how we can get high risk to reward trades. So for example, 1 to 10, 1 to 20, 1 to 30, those kinds of trades. We don't want to be catching just 1 to 2, 1 to 3. Because at the end of the day, that just means if we catch a 1 to 3 risk to reward ratio, that means in 3 trades we could lose all of our profits. However, the higher risk to reward, the better for us. So what I was requested to do was do a breakdown of 1 win and 1 loss. So I will quickly do that first before I break down my favorite pair, which is UK 100. So let me go on to GJ. GJ, we took a loss on today. Now, one thing I want to talk about a lot in this video is the fact that trading smart money versus retail is going to be very important, and you're going to see exactly why in this specific trade that we took. So literally all that we did to start off was we went on to the daily charts. Everyone's heard of a top-down analysis. Now this is something I wanted to talk to all my Signal subscribers as well as everyone on Instagram about. Is I'm beginning to shift away from a lot of lines and actually just a lot of shit on your charts, because otherwise it just makes it messy. Even this is just messy for me. I'm a very big fan of clean charts and just actually seeing what price is doing, seeing where liquidity is, because that's what drives a market. It's not necessarily just looking for your general support and resistance, and you're going to see exactly why that didn't play out nicely here. We caught a nice trade on Aussie dollar, Japanese yen the other day, literally just by trading simple break of structure, and then obviously a couple other confluences along with that, including an order block. But yeah, as I say, top-down analysis, all of this isn't necessarily for me. But yeah, in this case, you'll see how it went against us. So literally all that happened is we look back, we can see quite a nice level of supply and demand, support and resistance, whatever you want to call it, even until quite a bit further back, 15th of March. So the other day, there was quite a bit of news that came out for the Japanese yen, hence these two big pushes to the downside, creating quite a bit of imbalance to the upside. A better short position, more than likely, would have been over here, potentially waiting for price to come and retrace. There's quite a bit of liquidity above here at this current point in time, just above these wicks over here, as well as up over here. As you can see, there's a nice little order block over here and a nice one over there. You would just need to see what price does in and around those zones. But yeah, as I said, we were just trying to continue it down with the trend here. As you can see, it didn't work out for us there. So all that kind of went through my head in this trade. We broke below this previous supply and demand, support and resistance level, came back to retest it. We had a bit of rejection on lower time frames, so that's where we went and entered the sell, and literally almost instantly straight away we just got some bullish movement, obviously targeting order blocks and liquidity a little bit higher. As you can see here, the only real high that was broken at this point was this one over here. You can see how the market went to find more and more liquidity. Like, for example, there's a liquidity over here, there's liquidity over here. That high has not been broken just yet, but you can see it's currently on its way. There's more liquidity also over here. Now, that's something you need to understand, is the fact that smart money will always look for liquidity, and liquidity is above wicks and highs like this. Same goes for below lows, like over here, there's liquidity, more liquidity being created here. So yeah, that's just a quick breakdown on kind of what happened on this trade. Let me go to AJ. Did I clear this chart? Okay. Yeah, we did clear this chart. Okay. Let me just have a look at Euro. Where's Euro? The USD CAD. Sweet. So USD CAD was a very nice trade, as you can see, caught 235 pips or so. This was kind of using quite a bit of smart money concepts. As you can see, we faced very little drawdown here with a 30 pip stop. Nice risk to reward ratio of like 1 to 8 almost. So let's go just to a higher time frame. As you can see, this level in the past that actually acted as what we would generally call support and resistance. However, we actually had a nice little order block form over here, and as you can see, price mitigated that order block actually on a daily time frame quite nicely. As you can see, it broke that low over there on the daily. One thing you also need to understand, the higher the time frame something forms on, the more the market will respect it. Again, there's another order block over there. As you can see how nicely it got respected over there. Ignore all these other lines. As I say, charts can get quite messy if you're looking at a lot of things. But yeah, as I say, this was a very simple trade. All that really happened was we waited for a retracement or price to break above that level, come back looking for some more liquidity. As you can see, all these wicks here is liquidity, and we just came down, we broke again, and then came in here. You can see we didn't break any of these lows. You can see nice strong rejections down to the downside. Hence why this was a very nice trade to go and enter. If I'm not mistaken, we did enter on the second pullback just because of these rejections. Let's have a look on the 1 hour, see what happened there. Pretty much the same thing. As I say, you can see all the rejection happening over here. Hence why it was such a nice trade. As I say, barely any drawdown. And then literally just bought it all the way up to the next key level. As I say, there was a nice order block there on the daily time frame. as you can see over there. It mitigated a little bit more than 50% of it, which is cool. But yeah, as I say, our take profit was at 50% of that order block. So yeah, that's just a quick little analysis because it's not necessarily really what I want to talk about. I want to talk about more why these trades are found and how they found, and why these nice risk to reward ratios come into play. And this is just a prime example. You saw on GJ, not necessarily using any smart money concepts. As you can see, trade went against us to go and find liquidity. Over here, smart money concepts are used. Check that 1 to 8 risk to reward ratio, and you can see how well it played out. So yeah, let's go to UK 100, being my favorite pair. Now this is another thing I want to explain. A top-down analysis, it's just, for me, it's more of a retail thing to do. Once you begin to understand institutional ways of trading and the way smart money move, you'll just begin to see more and more the opportunity in the market to make more money without actually going ahead and losing so much. So, and as I say, you can get nice risk to reward ratio trades. So yeah, one thing I wanted to go back. So as you can see, we're on our 30-minute chart now. Once again, as I said on my Instagram, completely clean chart here. No trend lines, no support and resistance, no supply and demand. This is purely price action and liquidity trading, and then looking for order blocks. Nothing too serious. However, at the end of the day, this for me has made me way more money than any other concept that I can think of. So let's get right into it. Now, as I said, the market runs on liquidity and money. At the end of the day, this is a $6 trillion a day industry. So we can see a nice strong rejection to the upside here, creating a lot of liquidity to the upside here. As you can see, there was liquidity over here where this wick went and created it. Now this high went and took all of that liquidity. So basically what that means is, let's say for example, there were a lot of retail traders that managed to get a very nice entry over here, nice little tight stop, and we have our targets at the next low, right? Now what's going to happen is price is going to come all the way up and take those stop losses. Stop losses, buy stops, anything like that are all liquidity, and that's what the market, as I say, runs on. So over here, as you can see, easily stopped out, and we don't trade like that. So now literally all that we go ahead and do is wait. Now this for me is a very, very, very nice order block to look at. So we could potentially have looked at this one, which would be a very good option. For me, there's no imbalance or unfair pricing there. So this might be a bit of a better order block to look at. So what we can do, we go ahead, draw our box around our order block. Now what we can do is we look for any unfair pricing. So on the 30-minute there, you can see there's no unfair pricing, no imbalances or inefficiencies, whatever you want to call them. Now let's go down onto a 5-minute chart. So in a sense, this is technically a top-down analysis, but you must also understand that this is a very different type of top-down analysis. You can, as I'm going to remind you, there's no trend lines, no support and resistance, none of that on the chart here. So as you can see, this is the same block that we had just highlighted, and now can you see on the 5-minute, look at the imbalance that's being shown over here. We can see that there's imbalance right from the top there all the way down to these candles. Now, what did I say earlier in the video? An order block will more often than not get mitigated by 50%. So let's go and draw 50% in there. As you can see, the imbalance came and was filled. Now the other thing I wanted to say is this is a bit of a breaker block over here. So let me just zoom in a little bit. This candle's bottom, or low should I say, is over here, taking out all these other lows, creating more liquidity. So what you can do is you can go and grab a new tool. Let me grab my trend line, pull that out like this. Okay, so once again, I keep saying it, but you really need to understand the fact that the market runs on liquidity. Now, when it goes and creates a tiny little contraction like this and lows get taken out like this, you can assume, or it's very safe to assume, that this line specifically over here is going to act as a very nice support and resistance in inverted commas in the future, especially the fact that there's so much confluence here, the fact that it's inside this order block, the fact that it's inside this imbalance. You can already see how well it's gone and played out there, and that's where our entry would be. So we go and grab our profit tool. Now so as I say, smart money concepts allows us to get sniper entries and get proper risk to reward ratios. We can go and place our stop loss just above this high over here that was created, taking out that high. If you really want to be safe, you can go and place it just above this imbalance here, just in case, so that we don't get taken out. However, in this example, as I say, with the breaker block, the order block, and the imbalance, this is a very nice area to have entered your trade. So now, how do you take profits on this? Well, what you can do is go and look for the next low. Let me just get back to it here. Right, there it is. So to take profits, we'll look for the next low. So the last low was over here. So what we can do, we can look to take profits at that first one. However, that's not a very important low. For me, looking back, I want to see where lows were taken out. For example, over here, you can see over here, there was a lot of liquidity created over here. And again, there's another breaker block. Look at how that was taken out so cleanly. You can even see how even further back, this played out very well. You need to understand that the market makers and the banks all know what the market is going to do before it does it. And you need to understand how to pick those, and when the market is going to move, why it's going to move. This is why I'm teaching you smart money concepts here. So as I say, then what we can do is have that as our first take profit at this low, taking out all that liquidity, creating more liquidity over here. Let me just extend this along. As you can already see, that's a 1 to 22 risk to reward ratio. Now on UK 100, yes, that says 3.3 pips, but in actual fact, it's 33 pips. And over here, you can see it's not 73 pips, it's 730 pips. So as I said, 22 risk to reward ratio. Now what you can do is take 50% of your profit there, and then start looking to target even lower ones. So where can we take our next profits? We're trying to find liquidity in the market. There's liquidity under here, under here, under here, under here, and even under here. Let's see if we can find a little bit more. Okay, as you can see, all the way down here, there's just liquidity for days down here. So technically what you could do is you could just keep targeting the next low, next low, next low, next low, and just eventually start to move your stop loss. Once these higher highs and higher lows, or higher lows and lower lows were created, you can move your stop loss there, then there, then there, then there, then there, and then so on and so forth. So eventually, that would be our last target before getting taken out. And as you can see there, that's a 1 to 73, 74 risk to reward ratio. So that's literally how I would break down a pair with smart money concepts. what I'm going to do, let me actually go look for something else to potentially trade. So now, as I say, we need to find out where the market is going to come back for more liquidity, okay? And we need to think like an institution. We can't be thinking like retail. For example, where is smart money going to want to buy? Where's smart money going to want to sell? Okay. So let's have a look in here. Okay. As you can see over here, there's quite a bit of imbalance here on the 50-minute. Let's just get onto a 30-minute chart quick. So remember, this is where our last bit of take profit was, right? Now, as you can see, the market created a bit of imbalance over here. Here's a nice little order block. If you don't know what an order block is, it's the last down candle before a strong push to the upside, or the last up candle before a strong push to the downside. So as we can see here, what did I say? Liquidity. We created lows over here, creating liquidity. This candle came down, taking out that liquidity and creating even more further down. Now, I'm quite interested in this order block over here. Once again, as I say, we want to be buying and selling where the institutions are buying and selling. So for example, yeah, if you bought there, maybe you would have made a bit of money. But in all honesty, I don't see why else you would buy here other than that potentially order block. Otherwise, I don't actually see any other reason to enter there. Again, I'm looking for smart money concepts here. So let's go in and zoom in on this order block. Right, let's now pull this all the way across. Cool. So now let's go down onto a 5-minute chart. Let's see what's happening inside that order block. Cool. So now remember what I said. There's our low. There's liquidity that's just been taken out. There's more liquidity that's just been taken out. Another low that's gone and taken out liquidity. And that low there would be our breaker block, because we first created lows here before potentially going high. That's where retail would be buying. Now you can see over here, there's our breaker block. So what you can do is go and grab your line tool like this. There's our breaker block, as you can see there in red, just to make it a little bit easier to see. And as you can see, there's still imbalance to the downside here. There's still imbalance over here, all the way up like that. So now, inside this order block, you can either expect this to be filled by 50% or it to come down to this breaker block, right? Potentially even mitigating 50% of this imbalance. But even then, if we aiming to enter on this breaker block, it won't be such a bad thing if it just comes all the way down here, and you'll see why now. So let's go back to the 30-minute. Let's scroll all the way across. Sorry, let's talk about where we want to put our stop loss if we're going to be entering this. Right, so if that's going to be our breaker block there, in fact this is a 5-minute chart. What we could actually be looking for is enter on the breaker block and have our stop just below over here, or have our stop just below the imbalance. Right, that's just going to be purely up to you. As you can see, that already is 120 pip or 12 pip stop loss, whichever one you want to call it. Another thing you can do is even go down onto a 3-minute and try and get an even better entry. See what's happening here. Okay, so by the looks of it, we're not going to get any better of a stop loss out of this. So we're going to enter on our breaker block and have our stop loss just below this imbalance, just in case price comes down to fill it. One thing you must understand about smart money is they don't fuck around, and they will come and mitigate this perfectly. So let's go back to the 30-minute and do exactly as we said. So we said we're going to place our stop loss just below this. So let's just pull this block across. Cool. So grab our profit tool, enter on the breaker block. Let's get down to the 15-minute so you see a bit better. Cool. Now we bring this, put our stop just below. You can see 12 pips or so. Maybe we can get it a bit closer. Let's put it at 12 pips. So again, all that we're going to do is start targeting the next high. So, or liquidity for that matter. So let's zoom in a little bit here. You can see a little bit of liquidity was created above here and a little bit above there. So what you could do is target your first bit over there. That already is a 1 to 6.75 risk to reward. Next take profit 8.26. Next one almost 12. Next one all the way up here, that's at almost 15. Next one up there 16. Let's see if we can target anything else. As you can see, remember that liquidity we spoke about earlier? We could even be targeting as high as that, and that would be a 1 to 20 risk to reward ratio. So, as I say, all that we've done in this is we've covered risk management, how to calculate pips. So the point is, if you're going to be catching, for example, earlier a 1 to 80, I think it was, right? And you're going to be risking you can even risk like a 0.25 on that. So if you had to risk 0.25% of your account on that times 80, that means you would gain 20% on your account. So remember earlier how we said we want to risk, call it $2.5, right? If you have to go and times that by 20, so sorry, I'm talking Kakia. If we were to make 20% on a $250 account, that would be $50. So in the end, you're risking less than $1 to make $50 on that other trade over there. And this trade over here at this point with a 1 to 20 risk to reward ratio, let's see, 0.25 times by 20, that's 5%. So you're risking 0.25% of your account to make 5% on this trade and to make 20% on this trade. So I just hope that you guys can see and understand why I prefer to trade smart money concepts. It's not always that easy to understand, especially when I'm talking this quick and there may be certain things you don't understand. So if I can give you any advice, maybe just go and look up Ment FX. Let me just type it up here. Ment FX. So just go and look up Ment FX on YouTube. He goes into very deep detail on all of this smart money concept. He's very, very good at what he does. And he probably explains it a little bit better than me. He also talks very fast though. So yeah, as I say, if you want to go a little bit more in depth, that's the place to go. But yeah, I hope I managed to answer all your guys' questions. I hope that this video will help you. I'm sorry that it's gone on quite a bit long, but yeah, there's a lot of valuable information in this, and I think you can learn a lot from this, and maybe just help you look at the market slightly different. Because remember that a lot of people and a lot of traders will fail, and this is why they say 96% of traders fail and they lose money, is purely because they're trading retail. Everyone's taught to trade trend lines and supply and demand, or support and resistance, whatever you want to call it. You can also just see from this breakdown that I have not said anything about a candlestick pattern or any of that. All that I have spoken about is smart money concepts. And if you can familiarize yourself with smart money concepts, I promise you it is going to change your life. I mean, like, as I say, like a 1 to 80 and a 1 to 20, just those two trades alone are literally going to make you, so 20 and 25%, that basically means now in 2 trades, you'd have to lose 25 trades to lose all that money you've just gained. Whereas if you trading 1 to 2 or 1 to 3, you can really see that it's a lot easier to lose money that way. Especially when the market is against you and the market's always looking for liquidity and not support and resistance. I'm sorry to tell you, but yeah, anyway, I hope that helps. DM me if you have any questions. I'd be happy to help and have a chat if you need. Good job. Peace, guys. Enjoy your weekend.